The best way to make money is by not losing it. Somebody said that sometime. It was good advice then, and it's even better advice now, and it is why Dean Curnutt has a thriving business. Dean runs Macro Risk Advisors, an options advisory and brokerage firm that figures out where investors are likely to lose money and develops strategies to hedge those risks. Dean predicted the European sovereign debt crisis, and he's here to tell us what to watch out for next. Dean, there's been so much talk about contagion in Europe. From Greece, we saw it go to Ireland. Now people say it's going to Portugal, perhaps Spain, and maybe even Italy next. You're watching out for possible contagion here in U.S. markets.
I think one of the things we continue to learn is that the markets get very localized. They can only focus on one thing at a time. And in the case of the U.S., we've got very stimulative monetary policy, great corporate profits for now. Economic data is improving. And what that does is it causes U.S. investors to sort of overlook what's happening in the Eurozone. And we think what's happening in the Eurozone is going to be a repeat of what happened last year.
Now, a repeat of what last year, in what sense?
Well, actually, a repeat of what happened last year, but worse. Greece was last year's news, and now we've got, obviously, Ireland, Portugal, and if you look at Spain, a big concern we have is the rising CDS levels on Spanish CDS suggests to us that there's things are going to go wrong there.
All right, let's walk people through this, and I want to put a chart up that you helped us prepare that illustrates this point. Spanish credit default swaps versus the VIX. Now explain to us what's going on here. The white line is Spanish CDS, the yellow line is the VIX. What's important about this chart?
Our firm takes a very broad look at risk. We think of risk premiums as very correlated across all different asset classes. And if you look at that chart earlier in the year, you see that
they're following each other.
So there's a very high correlation between CDS levels on government debt and the VIX. It's Bernanke's QE2 campaign that's really pushed down the VIX, and I think it's allowed, or it's forced investors to forget about equity volatility, even at the expense of what's happening in Spain.
Because investors are effectively being paid to take risk?
That's exactly right. But Bernanke's sort of whisper to the bond market and the stock market is, trade with us, we'll help you make money for a bit of time. But to the extent that the Eurozone is unable to solve these the government debt problem in Europe, it's going to come back.
Who's ignoring these risks? Is it just sort of the retail investors, the turkeys at the table, so to speak? Because I see the results of a survey you did, and at least some of your clients are pretty aware that there's a whole lot of risk in European sovereign debt.
Absolutely. So a survey we just did asked investors what are the biggest risks out there, and sovereign was the most substantial risk. The equity fundamentals were the least substantial risk. I don't know that people are ignoring them. They're just getting forced into the market because, remember, bond yields are very low, and more recently, folks are losing money in munis and other credit products.
So at a time like this, when volatility is low, as represented by the VIX, and equities are heading higher, as they did again last week, what's the best strategy? Not to pile into the stock market, but to buy some cheap protection for yourself?
I think the Fed is again, it's still asking you to be long the stock market. Its QE campaign is telling you to do that. But at the same time, you have to be looking at hedges. You have to be looking at S&P put options, simple trades that allow you to buy insurance. And as the VIX is going down, and I think it's going to go down for a little bit longer, but it really does start to make sense to be looking at insurance.
Now, I know that in addition to sovereign debt risk, especially as it concerns Europe, you've been looking at this issue called underperformance risk. What exactly do you mean by that?
Well, people think about tail risk. It's almost assumed that it's to the downside, and that's, of course, generally the case. But there's an upside tail, too, meaning with what the Fed is doing and the stimulus that's being provided by central banks generally, there's a chance that the equity market could continue to go up. It could stray away from fundamentals, and to the extent that you're effectively being paid to at least track the S&P 500, to the extent you underperform, that's a big risk. And so a hedge...
Especially if you're being paid to perform against others.
That's exactly right. And so that's the underperformance, and you've got a vast degree of underinvestment in U.S. equities, money that could come out of bond funds quickly into equities. And to that extent, a tail risk hedge there is to buy very upside calls on the S&P 500.
So you have to look at it both ways. Effectively keep yourself protected on the downside, but make investments such that you can benefit if QE2 continues to operate and people effectively get paid to take risks.
That's exactly right.
Dean, thanks very much for joining us, as always. Dean Curnutt of Macro Risk Advisors.